if you've looked into buying a set of dumbbells, but if you're looking at just a set of dumbbells, anywhere from 10 pounds to 50 pounds for the whole set, you're looking at about $400 or $500 just for the dumbbells. Okay. Now, if you want to sign up for a gym, it's very easy to find gyms that you can get enrolled in for about $10 a month. So you do the math on that, $500 for one set of dumbbells, or you go to a gym where they have economies of scale, they sell a lot of memberships, and people end up sharing and leveraging all that equipment. And that same $500 in a gym membership goes a lot further. That's an example of economies of scale. Think of a cruise. My wife and I love cruising. You go on a cruise ship and you get all the food, all the activities, swimming, all this stuff included for typically around $100 per person per day. Like, in my mind, it doesn't even cover the cost of food. So how do they make money? Because of economies of scale. They're able to bring so many people on and get things at cost because they're buying it in bulk. That's what they're tapping into. It is no different for apartments. And we're going to talk a little bit more about this, but a lot of people, when they think of real estate, immediately they go to single family homes. And there's nothing wrong with that. And I think it can be a good investment, but it's often because they don't realize they can get into something larger without having to do any of the work. So with apartments, you have 100 units. We'll use 100 units as an example at one property. If 10 people move out, you're still 90% occupied. If you had a single family home and one person moved out, you're 100% vacant. So that's an example of the economies of scale that you can get just in one apartment building. And for us, that made sense because we're always looking for efficient ways to make money and efficient ways to grow and preserve our wealth. So that's one of the big reasons that made sense to me and our team when it comes to apartments. Second one is forced appreciation. This is huge for us. A lot of us on this call have probably purchased or sold a single family home. And if you sold, we'll say a year ago and any year or two leading up to that, 2020, 2021, you made out extremely well on your home. And that's because the market was working in your favor. But now prices have dipped, interest rates have gone up, prices have dipped on single family homes. You have no control of the value of your home. You don't. And with apartments, you're not just buying homes, you're buying a business. And businesses are valued based on how much income they generate. So you buy an apartment building, you renovate the units, you charge for pet rent, you charge for covered parking, and within reason, and tenants are willing to pay this. And what you do is you increase the income that that property generates. You increase it, and thus you force the appreciation. So we like that in the apartment space because it gives you a sense of control. That single family real estate just can't. It doesn't because of the way that it's valued. So again, reason number two, that made sense to us because we can invest into something that we have a little bit more control of. Stock market. Okay, do any of us have any control or influence on the stock market? And Warren Buffett doesn't count. We know whatever Warren Buffett invests in, it's gonna see gains, right? Because people follow, right? But any of us, if we invest in the stock market, we have no control. It's whatever the market is doing at that time. In commercial real estate, especially in apartments, you don't have 100% control. Let me be clear, but you have more control in this investment vehicle than you do in a lot of others. That made sense to us. Reason number three, this is probably one of my favorites. It's a basic human need. When you invest into apartments, you're investing into a community. And you don't need to be, nor should you be, a slumlord. A lot of us have probably rented from people, from landlords, from properties that we just weren't proud to live in. Now, as an operator, that's completely in your control. And you can provide quality homes, quality communities for these people. Some of our partners that we work with, they put on community events. They'll do back to school drives for all their tenants, and their kids will come and they'll get a backpack full of school supplies. That's cool, because now you're not just providing a home, you're providing a community for people to live in. And so again, that allows you to have impact, and that's important to us over at REV. So listen, I could write a book on 100 reasons of why multifamily, but I'm not going to do that. I just wanted to share with you 3 of the reasons that allowed our team, and I guess caused our team to focus in on this space. So how does REV fit into all this? What do we do? I'm going to introduce some different vehicles of real estate investing, and this will help you understand where we fit. So in this scenario, I'm going to present 3 situations: a good, better, and best. Again, this is my opinion. Take from it what you will. Okay. So scenario number 1, you have a person takes $100,000 and they invest into a single family home. Again, I think this is a good option. And a lot of us have bought or sold homes before, so we're comfortable with this. We get it. We understand it. And this is something that we can own ourselves. But again, it lacks economies of scale. This tenant moves out, you're 100% vacant. Your HVAC system goes out, you're going to be thousands of dollars in the hole, and any cash flow you were expecting to get for the next year or 2, probably gone. Water heater goes out, right? So it's hard to really scale in the single family game, but it's a way to get started in real estate investing. This is what I would consider more of a solopreneurship, or doing it on your own. Now, a better option, you take that same $100,000, rather than putting it into a property, you pool it together with a handful of other like-minded investors. So now those investors, that money's pooled together, they now have $10 million collectively that they can take and go and buy a larger asset than they could on their own. So now this $100,000 is pooled with other people. It goes into, let's say this is a 100-unit apartment building. Now that same 100,000 in scenario 1 that's going into 1 door is now being diversified over 100 doors. So again, if 10 people move out of this 100-unit property, you're still 90% occupied. 1 HVAC system goes out, that's okay. You have 99 to help cover that cost, 99 other units, right? So there's a lot more cash flow, a lot more money at this level to really operate it and run it as a business. And in scenario number 1, who's typically the landlord? Who's typically doing the maintenance? It's usually the person that makes that investment, because as soon as you start paying for maintenance or hiring property management, until you have a lot of single family homes, financially, it doesn't usually make sense. And so you're the one stuck doing all that work. Where in scenario number 2, since it's a business, you're able to hire property managers and maintenance people on site. So it makes it a lot more efficient, and it's hands off for you. You don't have to go unclog toilets. You don't have to go fix sinks. You don't have to do those things, because the business can support hiring someone else to do it. So it's a lot more hands off. This is a great option. We've done this ourselves, and we've worked with other investors to do investments like this. However, with the economy shifting and the market shifting, we wanted to get into something, offer something that we felt was more aligned with really growing and preserving our investors' wealth. And that's what we consider scenario number 3. Oh, I'm sorry. And this is often referred to as a syndication. A lot of us are probably familiar with that term. You're raising money for a specific deal. So scenario number 3, okay, same thing. You take $100,000, you pool it with a group of people. However, this time that $10 million doesn't go into one deal. It gets diversified across multiple deals. Okay. This is considered a fund. This is what the vehicle that REV uses today to really work with our investors and to provide quality retirement options. And not everyone we work with is just growing their retirement account. Other people just want to grow and preserve their wealth. And so they use this vehicle and they work with us to be able to do that. So think about it, okay? Scenario number one, you're putting 100,000 into one unit. Scenario number two, you're putting 100,000 into 100 units. Scenario number three, that 100,000, that same 100,000 might be diversified over 800 to 1,000 units in different markets with different deals. So what level of diversification you're seeking is going to vary from investor to investor. But what we wanted to provide, again, at this time in the market was this fund scenario. And that's where we operate. And obviously I'm going to consider it the best option. But again, just some basic education for you that are looking to get involved in the real estate and consider your options. Okay, as I wrap this up and before we turn the time over to Nate, I want to share with you guys the number one mistake that I see people making in this space. And we talk to a lot of investors. Like, since we operate a fund every day, all day, every week, we're talking to potential investors. And this is the number one mistake that I see people making. Investors spend 80 to 90% of their time vetting the property. Now, some of you might not agree with that or disagree with that statement, that that's the number one mistake. And the challenge here, and the reason that I could start the number one mistake, is because what they should really be spending their time on is the operator. They need to be spending 80 to 90% of their time vetting the operator. Because you can have a very, very good deal. You can have a very strong deal financially, and you get a poor operations team managing that deal, and they're going to drive that deal into the ground. Now, on the flip side, you might have an okay deal with a phenomenal operations team, and they're going to hit that deal out of the park. They're going to hit a home run. So the question is then, what reason do people have to not spend more time vetting the operator and just vet the deal? And the reason is because the deal is easy to vet in most cases. A lot of us have a basic understanding how investments work, how multifamily deals work, right? And we can look at the numbers and say, oh yeah, on paper, that deal looks great. But if the situation, if the team off paper isn't vetted, it doesn't matter how good that deal looks. And this is where we really pride ourselves at REV. We spend 80 to 90% of our time vetting the partners, vetting the operators that we partner with. And then when investors work with us, they know who we're partnering with, and they know the process that we've gone through to vet these operators. There's not a lot of content and not a lot of information out there on the questions you should ask and the red flags you should look for when it comes to vetting operators. And this is exactly why we've put together, I think it's a 4 or 5 page document that this is going to be sent to all of you tomorrow morning. So don't worry about it. But we put together this 4 or 5 page document of all the questions and things that we look for when we vet an operator. And I want to give that to you guys just because you're taking time out of your day to join us on this webinar. But I'm telling you, spend 80, 90% of the time vetting that operator. Because if you understand them, if you understand their process and how they vet deals, then the property is a little less important. And the market. Because again, if you have the right operator, they're going to pick the right deal and they're going to pick the right market. So we're going to provide that tool for you, just so you know and you're well equipped to start having these conversations with other operators, with other people that are investing within real estate. So with that being said, at this time, I'd like to go ahead and turn the time over to Nate Hare. And Nate is one of our really good friends and partners over at Directed IRA. We have used Nate and Directed IRA for all of our investors that have come in using their retirement accounts. So over the next few minutes, Nate's going to share with you ideas, suggestions on if you can qualify, if you can't, things to look for, and really help you better understand how this tool can work. And here's the thing, like apartments and what we do, we're one vehicle. We're one option that people can use their self-directed retirement accounts for. There's a lot more options out there. We're just one strategy. So Nate will touch briefly on that as well. So Nate, thanks for joining us, man.
Thanks, Dallin. Appreciate it. And thanks everybody for joining. I know it's late. We're going to talk about retirement, but I promise to you, I'm not going to put you to sleep because this is going to be exciting. I'm going to tell you guys about retirement the way that I'm learning it, or not learning it, have learned it, and what you could really do with a retirement account that your advisor, your CPA, and a lot of the professionals out there are not telling you. So I'm just going to jump into it. And I just want to remind people, if you've got questions, hang tight with questions. We'll take questions at the end. I'll save about 10 minutes and you can ask me and Dallin questions, but I'm just going to jump into this and share my screen. So tell me if you guys can see that okay. Thumbs up.
And I would ask too, if questions come up while Nate's presenting, please throw them in the chat box. Because if you don't, you might forget it, and then we're going to move on to other topics. So make sure it's in the chat box so we can always come back to it.
There you go. So I'm going to go somewhat fast on this, but like Dallin said, you guys will get a recording of this. If you guys even want the slides, I don't mind sharing these slides with you guys. You'll have my email address at the end of the presentation. So don't worry if you miss something, because I might go a little bit fast, but I want to cover at least some of the basics about self-directed IRAs. And what we're going to cover in the next 30 minutes is, we're going to talk first, what are the rules? What can your IRA own? What your IRA or 401k can own. Most people don't even know what this is, and this is very important when we talk about self-directed IRAs. I'll talk about just some benefits about owning real estate in a self-directed IRA. We're not talking about apartments. We're not talking, and I'm not promoting REV in any way. We're just going to talk about the fundamental difference between a piece of real estate and a stock. Then we'll talk about the 7 different plans that can be self-directed. Now, I tend to say IRA and 401k a lot because that's what most people have when it comes to a retirement account. But we actually have 7 different types of plans that can be self-directed. Some of them are retirement plans. Some of them are just savings plans, like an HSA or an ESA. Some of you people on the webinar today might have a health savings account. That can actually be self-directed. We'll talk a little bit about that and talk about the tax advantages each of those plans has that can be invested into real estate or other alternative investments, I'll say. I'll cover a little bit of regulations and rules just of what not to do in an IRA. And these are more things that self-directed IRA custodians like directed IRA has to talk about. Your Fidelities and Charles Schwab's never have to tell you about these rules because when you're investing with Wall Street, you don't encounter these types of rules. And it's really about self-dealing. We'll talk about that. And then I've got a case study to just kind of build the foundation, put everything together, and help you guys understand how do you actually take an IRA or 401k and buy real estate without creating a whole mess or create a whole bunch of taxation, because there's a lot of misconceptions about how it even works. So let's just get into this, and just a little background about myself. I actually started in real estate. Okay, and the presentation is not about me, but I just want to tell you about my background. Out of college, I went right into real estate. I was a mortgage broker. I owned a lot of I started buying and selling real estate. And that was my background in niche. Never in my 12, 15-year career did anybody ever tell me that I can take my retirement account and invest in real estate. Had I known that, that would have been a life-changing event for me. It took me all the way till 2012 that I started working in the industry that I even heard of this term self-directed IRA. And at first, when I learned about it, I thought, well, how come everybody doesn't know about this? Is this even legal? It blew my mind that an IRA can be used to own a rental property or a piece of an apartment building. I just thought you just bought stocks. So it was a life-changing event for me. That's why I get so much enjoyment teaching other people about it. And it's not about telling you what you should invest in. It's just telling you what you can invest in. And it's really up to you when you have a self-directed IRA. So I'm a CISP. That's just a nerdy term, meaning I know a lot about IRAs and retirement accounts, not just self-directed IRAs. And I passed the test, the nerdy test by the American Bankers Association. And I've got 10 years of experience in the self-directed IRA world. So there's not a self-directed IRA investment strategy or scenario I haven't seen a couple hundred times and have dealt with it, good, bad, and otherwise. So you guys can always lean on me if you have questions. Even if you're not a client, reach out to me and I'll have my contact information here at the end. Even though I have some experience being a self-directed IRA company and being an executive at a self-directed IRA company, I can't give you tax, legal, or investment advice. So this is just a disclaimer saying everything that I'm going to share here is just for education purposes only. We always encourage you to consult with your professionals, but really it's up to you to invest in what you understand with a self-directed IRA. We don't sell you investments. And there's some goods and bads to that, and I'll explain that as we kind of define what self-direction really means. So why do we talk about retirement accounts, and why do we find this so important? Well, retirement accounts are the largest source of Americans' wealth, okay? There's $35 trillion in retirement accounts, okay? Trillion with a T. More people have money in their 401ks or IRAs than they have in their bank account. The largest source of American retirement now is IRAs. It's no longer 401ks. 401ks used to be the vast majority of retirement accounts. Now it's IRAs. And most of that is because people retire, people leave companies, people transfer companies. And those 401ks that they had at that previous job, typically, if they're not rolled into another 401k, they roll into an IRA. The important thing I want you to understand about that is once you leave a company, that's usually when you can self-direct. The hardest accounts to self-direct are your current employer plans. So if you're working at a job and you've got a 401k there, they may or may not let you roll that into what's called a self-directed IRA and invest in alternative assets. But the important thing is you should understand where your money's at or what it's invested in, especially if you have control over it, because it's the largest segment of our economy. So let's talk about rules. Why are you just now hearing that you can invest in real estate and not stock, or not just stocks? Well, you can invest in anything the IRS allows, and the IRS actually does not tell us what we're allowed to invest in. There's not some long list that says you can buy this, this, and this. They only say you can't invest in two things: life insurance contracts and collectibles. That's it. Anything else you can generally hold title to can be owned in the name of your IRA. And the industry terms for this would be traditional investments versus alternative investments. Traditional investments are just an option. And those are your typical stocks, bonds, mutual funds, ETFs, REITs, and CDs. Okay, these are sold by your Fidelities and your Charles Schwab. We call these traditional investments. But if you ask your advisor at Fidelity, I want to buy a rental property, I want to buy a commercial property, I want to lend some money to a real estate investor, I want to invest in a syndication, what they're going to tell you is no, you can't do that. What they mean is no, you can't do that with them, because they don't sell that as an investment. You got to remember, Fidelities and Charles Schwab's, they're licensed securities brokers in the business to sell investments. Doesn't make them bad guys, but just remember, if you've got your IRA or 401k parked with them, they're only going to sell you, or they're only going to let you hold what they sell. Okay? A directed IRA, we don't have investments to sell. Okay, but it's still an IRA. It's the same IRA legally as a Fidelity IRA. The only difference is when you have an IRA with us, the account agreement says you can invest in anything the IRS allows, but you tell us what that investment is. Okay. So it opens up the game for you to invest in all sorts of things. Now, I will tell you that most of our clients do not just have a directed IRA account. They have a Fidelity IRA and a directed IRA, because there's no limit on how many IRAs you're allowed to have. Now, why would someone want to have a directed IRA and a Fidelity IRA? Well, it gives them more options for investments. If you really want to diversify your retirement portfolio, don't you think you should hold maybe some traditional investments and some alternative investments? And if you actually look at the numbers, and they don't share this very often, maybe we just look at it because we're nerds over here and we follow this stuff. But as your retirement accounts grow, and there's studies on this, as you look at the higher valued retirement accounts, IRAs and 401ks, the larger the retirement account is, the higher the percentage of alternative investments in there. I'm not trying to sell you on alternative investments, but the rich and the wealthy have been investing in alternatives for decades because A, they've had access to investments, and they just understand where they want their money. look at the asset breakdown of family offices. Family offices hold about 50, almost 60% of their assets in alternative investments. If you guys don't know what family offices are, they invest a lot of money for a lot of rich people, but they've been doing this for decades. And this is not a new concept. It's been around since IRAs were created. It's just that your Fidelities, your Charles Schwabs are never going to suggest to you to invest in it, because why would they do that and have you invest in something they don't make money on? So the only things you cannot.
Nate, real quick, I wanna add to that. So you can find various studies to this, and when Nate's sharing, like as you look at the larger portfolios where their investments are, you can find information on that to a point where some studies will show that the traditional investor, or the high net worth investor, so you're talking around a net worth of around $1 million, they may only have about 10% of their investment portfolio in alternative investments, meaning they're very stock heavy. Now you start looking at the ultra high net worth, people that are worth 10, 20, 30 million or more. You might see their portfolios of close to 80% in alternative investments.
Yeah.
So
There's actually a study. Yeah. If you guys want to nerd out, look up, there's a Forbes article, March 2020. I got it memorized, March 2020, where they talked about watch out for your self-directed IRA. They're coming for you. That's basically what the title was. I'm paraphrasing. But it catches you off guard, because you're like, oh no, what's wrong with these self-directed IRAs? And basically the gist of that article was they're looking more into self-directed IRAs because that's where the alternative assets are. And it was interesting for them to find that the smaller dollar IRAs, we're talking anything under 5 million, only 2% of those IRAs were self-directed. But as you get to all the IRAs valued above $5 million and more, 25% of those are self-directed. It's a huge difference. And as you get even higher than that, it gets closer to 50. And like you said, Dallin said 80. There's a lot of different studies that show as you get more money, more of that transfers into alternative assets. So take it for what it's worth, but the rich and the wealthy have been using these for decades. Is just now becoming more popular, I think, to the everyday person, because of really, it's because of technology and the availability for information. Now, the everyday person, it's not just the people in the know that can find these alternative investments, it's everybody. Right? We're doing this webinar today. These didn't exist a decade ago because nobody even knew about these types of investments. So thank you to Dallin and the folks over there for putting this on, because again, your Fidelities aren't going to share this information with you guys. So why is real estate attractive in an IRA or a 401k, self-directed or otherwise? Well, here's some of the differences that I came up with that are different than a stock. Okay. Obviously, everybody understands what a mutual fund is. It's just a bunch of stocks, and everybody understands what a stock is. But understand the fundamental difference between a stock and a piece of real estate. When you invest in a stock, that stock can go up and down like real estate. But the difference is you invest in the wrong company, you don't have anything of collateral, right? You can lose everything in an IRA if you invest in the wrong companies. Now, obviously, you want to diversify to keep that from happening, but it's not a tangible investment. Okay? A stock is not tangible. Okay? It's not tangible like real estate. Real estate's like my desk. Right? You can drive by it, you can touch it, you can feel it. You buy a piece of real estate, and let's just assume you buy it cash. Even if that piece of real estate burns to the ground, you have insurance that covers your losses. Why? Because insurance companies will pay you back if your tangible asset burns to the ground. Okay. Is there insurance for your stocks? No. And I'm not calling stocks bad. I'm just saying, if you've got all of your money in stocks that can fly away in the wind, you're at risk every day to lose your retirement account. This is probably why the ultra wealthy invest a lot of their assets in tangible assets like real estate. One of the things with real estate, it just gives you better diversification. You don't have to be a real estate investor or be an expert in real estate to understand real estate makes a lot of sense as an asset class. Okay. It's the largest segment of our economy. So diversification is something that people look for, and real estate's one of the best diversification tools in an IRA. We also talk about tax savings. So tax savings is key because IRAs, 401ks, and other qualified plans are not taxpayers. Okay, they're not taxpayers. If you guys make sure you guys are muted, by the way, too. Yeah. So, IRAs, 401ks, and qualified plans are not taxpayers like you and I. So if you're making sure that you're investing in your IRA, remember the benefit is, the trade-off is all of your investments grow tax deferred. It just depends on what type of IRA you have, whether or not the distribution is taxable or tax-free. But even traditional and Roth IRAs work the same as you buy and sell investments. So I can buy and sell a piece of a property, and there's no capital gains tax that hits my IRA, meaning that I can take all of that capital and reinvest and profit and invest into the next deal and the next deal and the next deal. And I don't pay any taxes while it's being invested in my IRA. So I can grow my bucket of money bigger, faster than if it was my money as a taxpayer, because I have to pay taxes annually. So there's a lot of benefits to investing in real estate with an IRA. Now, there's some CPAs that will say, well, Nate, why would you ever invest in an IRA, invest in real estate in an IRA when you don't get depreciation? That's one of the dumbest comments I've ever heard, because it's a moot point. What do you need depreciation for in an IRA when an IRA doesn't pay tax? If you're looking for depreciation to offset personal income, buy some real estate outside of your IRA. I'm not saying you have to do one or the other. You should be doing both. But if you're taking your money out of your IRA to go buy real estate, I think that defeats the purpose of the IRA, that it's tax-free to begin with. But if you have an IRA like a Roth IRA, Roth IRAs are my favorite. Roth IRAs, you can buy and sell 100 different pieces of real estate, never pay any taxes on the gains. And when you hit age 59 and a half and you've had a Roth IRA open for 5 years, you can start taking tax-free distributions to the rest of your life. I have clients that own property, okay, in good areas that cash flow, and they own it in a self-directed Roth IRA. When they're 59 and a half, they don't start selling assets like real estate. They don't start selling it like you have to sell stocks to live in retirement. They've got cash flowing properties that every month cash comes into their accounts, their Roth IRAs, and they just take a distribution of the rents completely tax-free and just leave the asset appreciating over time. It's a great way to retire when you've got cash flow and you've got appreciating assets. Apartments is another example of a cash flowing asset that appreciates. So it's amazing what happens when you can start applying your knowledge of IRAs and 401ks and Roth IRAs to real estate, because it's a different type of investment than a stock. You've got multiple income streams that are all tax-free if you use it right. But it's also a socially conscious investment. And that's not a political thing I'm trying to mention. It's just a real life thing that I see every day, because most of our clients who are investing in real estate or loaning to a real estate investor or investing in a syndication deal, what they're doing is they're investing in assets that are in their own community. They're investing in, eyesore, ugly houses that they're fixing up and putting in, contractors to do work and paint new paint. And, people are moving in, REV equity are buying, probably distressed assets sometimes, but assets that just need to be better managed. That's an investment that does a social good for the community, I would say. It's very different than just investing in some nameless, faceless mutual fund, and you're just looking at a statement with a name, seeing if your account balance went up or down. So the thing that I really like about self-directed IRA investors is I see more than just their account values go up. I see people being employed through the real estate business. I see all sorts of good things happening. And when you're in control of your investments, you can point down the street and say, oh yeah, I helped rehab that house with my IRA, or I helped build that apartment with my IRA. It's a very different feeling when you start actually thinking about your retirement assets that way. So, but I know everybody wants to look at the dollar signs, but I just like to throw that out there because that is a real life thing when you talk about self-direction, and you get to pick your own investment. But again, what I would probably say to you guys is just invest in what you know best, okay? Or invest in what you're comfortable with. This is not a presentation to tell you what you should invest in, but just a presentation to tell you about what you can invest in. And I think you'll make better investment decisions as you learn more about your investment options, but just invest in what you know and you understand and you're comfortable with. So here's the 7 types of plans that can be self-directed. Now, most people just think, traditional Roth can be self-directed. If you go online, most people just talk about self-directed Roth IRAs. So much so people think it's the only account that can be self-directed. But it's a great account that could be self-directed. But you can also self-direct employer plans. Okay, employer plans would include your SEP IRAs, your simple IRAs, or even your own solo 401k. If you've got a small business, no W-2 employees, that can be a great account that can be self-directed. Now, the difference between, say, a personal plan and employer plan is just the amount of contributions you make, but the employer plans are for people who have self-employment income. I have clients that have personal plans and employer plans because you can actually contribute to both if you even work a W-2 job and you're self-employed. What I want you to take away from that is when you have multiple accounts, it benefits you because it's less money Uncle Sam can touch. If you're just trying to self-direct your traditional Roth, remember, there's only a limit. There's a limit on how much you could contribute each year. Don't get contribution confused with profit, though. Profit is unlimited. Profit does not go against your contribution. But if you're looking to take some of your earnings and have it grow or tax-free, you want to understand what are some other buckets I can put money in that I can invest with that Uncle Sam can't touch until maybe later down the road. So traditional IRAs and Roth IRAs can be self-directed, but you can also self-direct employer plans. The other accounts I kind of mentioned at the beginning would be your health savings accounts and your education savings accounts. Now, these are powerful tools with self-direction, and most people don't even realize they can invest their health savings account. I would probably say 50% of the people I talk to that have a health savings account, it's just in cash. And they don't know that they can invest it. They just think of the first benefit with a health savings account, which is what? I get the tax deduction when I put money in, which is great. And which is why the first account I contribute to every single year is my HSA, even before my Roth, because I don't get a deduction with my Roth. I get a deduction with my HSA contribution. But it grows like a Roth because I can invest it. I can even invest it in, and I'll tell you what I invest in here in a sec. But when I invest my health savings account, I don't have to wait till retirement to use the money in the health savings account tax-free. I can take a distribution of my health savings account and pay for the glasses that I'm wearing. I pay for prescriptions, doctor's visits, acupuncture, holistic medicine. There's a whole list of things you can pay for that you're probably paying for right now with money in your back pocket. But you can consume more goods with the same amount of money if you just start switching your mindset as an investor and say, let me put some money in my health savings account, invest it, grow it tax-free, and then I can just buy all those things with tax-free money, okay? Instead of taxable money, which is what most people do. And then education savings accounts, they're a small account, but you can set them up for your kids or your grandkids. You can self-direct them. The contributions are small. It's about $2,000 per child per year, but we have a lot of clients that set these up for their kids. And when you invest them and you make profit, take the profit out and pay for qualified education expenses tax-free, things like tuition, room and board, books, computers, iPads. I'm not going to spend too much time on it. I do classes on this. If you guys want, I'll follow up with me. I'll kind of teach you guys more on that. But these are not retirement accounts. And the thing I want to make a point is you can partner all these accounts together when you make investments. So for instance, let's say I want to buy a rental property. Let's say I've got a Roth IRA for myself, a Roth IRA for my spouse. We have a family HSA, and we have 3 kids that have a Coverdale each. All of those accounts can partner together to buy a rental property. Okay. You're like, how do those accounts buy a rental property? Hold that thought. I'll show you the process here in a second. But the main thing I want you to understand is that by partnering accounts, you maximize your tax savings. You maximize the ability to use tax-free dollars, not only to save for retirement, but to pay for health expenses and pay for current expenses like education. Okay. So just keep that in mind because there's a lot more to self-direction than just a traditional Roth. You can start saving money today by paying things out of those types of accounts through your investment profit. And account type matters. And we'll talk a little bit about this, but account type matters, especially when you're investing in things that appreciate and things that have cash flow. Okay. I think I kind of mentioned this, but the Roth IRA is my favorite, account, especially when it comes to self-direction, because I kind of mentioned to you, when you reach 59 and a half and you've had the Roth IRA open for 5 years, you have what's called qualified distributions, and qualified distributions are tax-free and penalty-free distributions for life. The IRS hates big Roth IRAs, I will tell you. Okay. If you guys ever watched the whole Peter Thiel thing, okay, we had a whole lot of regulation that came out right when people found out Peter Thiel had a $5 billion Roth IRA. Why does the IRS hate the Roth IRA? Because they don't get tax money. They love big traditional IRAs though, because they get their dollars all the way through retirement. So if you want to spend less in taxes over the long run, think about having a Roth IRA. I'm not saying anything's wrong with the traditional IRA, but what you want to really identify is how do you want your money to grow? Taxable or tax-free? I'm the type of person where I want my investment profits to be bigger than my contribution. Okay. I only put a small amount in my IRA and I use lots of different leverage to grow my Roth IRA. So it's the investment profit that outweighs my contribution. If my investment profit is much bigger than my contribution, I don't care about the deduction. I want the tax-free profit. Okay. If you're only being very conservative and putting lots of contributions in, and maybe your contributions are what's the major part of your IRA, then you probably want the tax deductions. Okay. But Roth IRAs with real estate work phenomenally. And I will tell you, the IRS is not a big fan of them, but hey, they made the rules. We're just playing by. So let's talk about just some rules real quick, just so you guys understand, how these IRAs work and the one thing you really can't do. The one thing you're not allowed to do with an IRA, any IRA, is self-deal. Okay. You got to remember that your IRA is a separate entity from you. It's actually by definition a tax-exempt trust. IRAs and 401ks, even HSAs, they're tax-exempt entities that allow you to save for retirement or pay for the expenses I kind of mentioned. But when you make a contribution and you buy investments in those accounts, it's owned by those accounts, which means you're the actually fiduciary of that account. You have a responsibility to make it grow, to help save for retirement. But the thing the IRS does not want you to do is self-deal your IRA to yourself. You're a disqualified person to your IRA. You have a disqualified person, you have a fiduciary responsibility. And as a fiduciary, you're not allowed to sell assets to your IRA or buy assets from your IRA because you make the decisions for both. Okay. Your IRA doesn't make decisions, you make the decisions for it. So what you're not allowed to do is transact with your IRA. You have to transact. Your IRA has to transact with people that are not disqualified to your IRA. The reason why you never hear about this from Fidelity is you're never transacting with yourself. You're transacting with Wall Street. You're buying stocks on the exchange, right? You're never buying stocks from your spouse or your kid, okay, or yourself. You're not doing that. But in the self-directed IRA world, we have to mention that because you do have personal assets and you have to understand that you can't sell personal assets to yourself. You can't loan money out of your IRA to yourself. You can't loan money to your spouse. It has to be to what's called non-disqualified persons. I'm not going to bore you guys too much on this, but the people your IRA, cannot transact with are yourself, your spouse, kids and grandkids, their spouses, and then parents and grandparents. Okay. The reason they disqualify those people is that's usually how money passes. That's usually how wealth passes. When you pass away, the majority of beneficiaries are spouses and kids. So when you pass away, your IRA turns into an inherited IRA to those individuals. So they're equally as disqualified to you because most likely they're going to inherit the assets when you pass and inherit it through an IRA. But there are family that are not disqualified. That would be your brothers, sisters, aunts, uncles, cousins, nieces, nephews, any family to the side. Your IRA could do business with them. Now that there's a whole nother conversation we can have on whether or not you should loan money to your brother out of your IRA. I can talk about that for a long time. But just remember the people you cannot invest with, and it's really yourself, your spouse, and your kids. Okay. Remember your benefit. Yep.
Nate, just so you have a heads up, we've got 10 minutes.
Yep,
so
I'm almost done here. So
okay.
Remember your benefit comes from distributions. Okay. That's how you take your benefit. Until that time, you invest the IRA and you take distributions when it comes time to take distributions. I'm going to do one quick case study, tell you how this works. In order to self-direct, you have to run transactions through us. It's no different than running transactions through your Fidelity, right? When you tell Fidelity to buy stock, what they do is they exchange your asset of cash for an asset of stock. When you decide to sell it, it goes back to an asset of cash. What we do at Directed IRA is the same exact thing. We just do it with real estate. So we exchange your assets of cash for an asset of real estate when you find the real estate you want to buy. And then when you tell us to sell it, it goes back to an asset of cash. We don't pick the real estate for you, but we buy it in the name of the IRA. And there's some documents that we need for this, but it's not treated as a distribution. That's the thing that most CPAs and advisors get confused with. If you say, hey, I want to start buying real estate with my IRA. They go, no, don't do that. You're going to pay a bunch of taxes. They don't understand that we're not distributing money out of the IRA. We're just exchanging asset types just like they do at Fidelity. Okay. And what I'm going to do is I'm just going to kind of just, I know I want to take questions. Okay. So let me just breeze over this real quick. Actually, I don't have time. So I apologize. This will be in the presentation if you guys want. This just kind of shows you how you take title to the property, the vesting that you use. And it's just an example of one of our clients that bought a small multifamily building. Okay. Now you can see there it's $375,000. Okay. This was from a rollover IRA that she used. Okay. She negotiated the purchase price. She found the property, but the buyer on the contract was us in the name of her IRA. Now we don't own it. We hold it in the name of her IRA, just like Fidelity holds stock in the name of your IRA there. Okay. When she sold it, this is the profit and return from it, but she was in control from beginning to end. Okay. And just to let you know, this house appreciated. Okay. Over 2 years, she collected rents. So she had some cash flow and she had a pretty healthy return. Okay. This is a perfect example of what clients are doing today. Now, if you don't have a big IRA, that's okay. If you don't have a deal, that's okay. Because you could still buy real estate, even if you're not experienced, or even if you have a small IRA. Okay. Because an IRA can use leverage. An IRA can use all sorts of leverage. It can leverage money, time, and experience. There's banks that will loan money to your IRA if you want to actually borrow money. If your IRA wants to borrow money, people don't even realize that. Time is you can leverage the time of others and you can leverage the experience of others. And this is what Dallin was talking about when he talked about economies of scale. Is most clients that self-direct, I would probably say 80% of them do not go out and find their own deals. Well, they go find their own deals, but they don't find their own property. I'll say that because it takes time. Okay, it takes time and they don't have time. They might work 9 to 5 jobs and they don't have all the money, but they leverage the experience of others like Dallin. And that's why we're so appreciative of them for sharing this with you guys. I'm not promoting them or endorsing them, but if you guys have retirement accounts and you're looking to invest in real estate, sometimes you do have to lean on the money and time of experience of others. And what Dallin mentioned is there's a lot of other investors investing with them. So if you want to join in those types of investments, self-directed IRAs are probably a good fit for you. But you can invest in all sorts of alternative investments. This is just one example. Remember, IRAs can invest in anything except life insurance contracts and collectibles. So I know I went a little bit fast, but again, I'll share the slides with you guys. And if you guys want more education, I've got a lot of different workshops, including a workshop that we did with Dallin back in June. Just scan that QR code if you guys want to learn more. We've got a bunch of different presentations up there. And if you want to schedule an appointment with me to talk a little bit more about it, I'm open, I'm free. Just scan that QR code and you can set up a time with me on any available time I've got on my calendar. And that's my email if you guys want to reach me. So sorry, Dallin, I know I went a little over. I tried to go as fast as I could, man. I didn't want to lose people.
It's so much good information, Nate. It's difficult. So Nate, if you could share this slide deck with me, then we can get it out to all of them.
Yeah,
email tomorrow.
Yeah,
so that way you guys can go back. I know Nate cruised through a lot of it. And one thing he missed there that I need to highlight, we've got a special for you guys too.
Yeah.
So if you put in the promo code REV100, you'll get $100 off your first year of annual fees. I believe that. Is that correct, Nate?
Yep. First year's annual fees. Yep. $100 off.
So listen, directed is extremely affordable. And that's why we, with all of our investors that want to roll over some of their retirement accounts. So really great deal. Again, we'll get this PowerPoint sent out to you guys tomorrow, along with some of the other resources we have as well. So we'll send this recording of this webinar. And again, we're going to include that 4 or 5 page document that we literally go through as we vet operators. You guys will see the questions and the information that we look at before we place millions of dollars with these people. And I don't care if you're working with us or working with someone else, you all need to have that information to know what to ask. So that will be coming out in the email tomorrow as well. So excellent. We got some questions here. And again, we're probably going to go over a little after 7. So if you guys got to jump, appreciate you joining us. but I do want to get through some of these questions in the chat box here. So we got a couple questions from Jessica. Are there stipulations on investing in private equity with a self-directed IRA? Thinking
Nope.
private equity may be the groups that buy real estate. Jessica, would you mind expanding a little bit more on that question?
I think I just have a general knowledge of it. I wasn't sure, maybe difference between a syndication and a private equity. I'm part of a coaching program, and they often do investing, and we basically form like an LLC or something, or maybe it's a holding or a private equity. Not really sure
Yeah,
what all
so
that is, but
it's private equity.
invest into that. Okay, I can invest in that group thing.
Yes, you can. So a syndication is one of the structures, one of the vehicles, if you will. Private equity is basically anything outside of your traditional stocks, bonds, mutual funds. So when there's companies like REV or companies in this group that you're a part of that say, hey, we have this investment opportunity, here it is, that's likely private equity. And so, yes, you can use your self-directed IRA accounts to invest in those opportunities.
Yeah, and you might even hear, anytime you hear private, you want to think self-directed IRAs. If you think public, then that's, you could probably do that at Fidelity or Charles Schwab. Same thing goes for REITs. There's actually private REITs and public REITs. So, and most people just think when you invest in real estate, you could only invest in a REIT. That's another misconception we hear all the time. Oh, you must invest through a REIT. No, I have a rental property. How do you do that? Well, so anytime it's a private asset, not on Wall Street, just think self-directed IRAs. Good question. We get it every day.
And there's another question. Do you offer checkbook control?
We actually do. So this is there's not a lot of companies that do offer this. And the reason why we do, well, let me first explain checkbook control just real briefly so people understand what he means. Checkbook control means what I'm going to do with my IRA is not invest directly in the real estate. What my IRA is going to do is invest in an LLC. Okay, I can even invest multiple IRAs or HSAs in an LLC. And that LLC, I'm going to manage it as the IRA's fiduciary. I don't own the LLC. My IRAs and retirement accounts own it, but I'm going to manage it. I will tell you, be very careful. You want to make sure you understand the rules because it doesn't make the prohibited transaction rules go away. You still can't buy your own assets or self-deal. But a lot of companies will not let you manage the LLC that your IRAs own. Now, the reason why we do it, because it's not illegal, if there's no rule saying you can't do it, but we have I will say, sister company 3 floors up from us called KKOS Lawyers. It's ran by the same executives that run directed IRA. They're both lawyers. And we set it up ourselves. So we set it up compliant to all the IRS rules, and we'll set it up for you here, give you some education on how to use it. And it does allow you to have a little bit more flexibility because you write the checks. You have control over the transactions in the bank account, and it's kind of out of our hands. We show you your IRAs own the LLC. It's still an IRA asset, but it's in a bank account that you control and manage. And we do offer that.
Excellent. A lot of great questions. Jessica, you got a few more in there. I'm going to encourage you to jump on a call with Nate and his team because those are very good questions and they'll be able to answer them more specifically to your situation.
Can I just answer it I'll answer it generally though, because I did see your question, Jessica, about the I think it was the TRS or the TSP. Any employer plan, 401k, 403b, 457g, TRS, TSP, any of those acronyms, if you have separation of service, meaning you're no longer working with the company, most likely you can self-direct that because you're not a participant in the company's plan anymore. If you're a participant in the plan, you're going to have to ask them if you have what's called in-service rollover options. Some companies do allow you to move some money out if you've worked there for a long time, you're fully vested, and you're above a certain age. It wouldn't be our decision on whether it gets moved. We'll accept it, but if you're still working at the company, that's best to just ask them. If you're not working with the company, most likely you can roll it into a self-directed IRA. All right, any other questions down?
There's one, do accredited investor rules still apply when investing in a self-directed IRAs? Yes, because the accredited investor rule applies to you as an individual.
Yep.
Now, you as the individual, if your IRA or a combination of your IRAs and other investment vehicles qualify you as an accredited investor, that's what we'd be looking for. But just being in a self-directed IRA doesn't make you exempt or like a workaround to that accredited investor status. Great question. Nate,
I see Carl's question. Oh, yeah.
yes,
Yeah, Carl, Carl, your contribution limits are actually for all your IRAs within that category. So when you talk about the personal plans, you got traditional and Roth, the $6,500 contribution limit, it's for all of your traditional and Roth IRAs. So you can't make a contribution, say, you can't max out your contribution Fidelity and then max out another contribution with us. Now, if you did that, nobody would know other than the IRS. You might have to, talk to them about what's called an excess contribution. But we do have the same contribution limits. If you've already maxed out a contribution somewhere else, you probably can't make another contribution here. But I would say, depends on where you want to put your money. Now, contributions don't go against profit. Remember, profit's unlimited. And how most people actually fund these accounts, I didn't talk about this, is by just transferring money from one of their other IRAs. And you don't have to transfer all of your money. Most people just transfer a portion of it to do whatever investment they want to do that Fidelity doesn't allow them to do. So, yes. So basically, they are the same, but they're in totality for those groups.
That's an excellent question. And what we see as on the operator side, the partner side, is exactly what Nate just said in that last portion. Most people that use a self-directed IRA to invest with us, they might have $500,000 sitting in an old retirement account, and they're just not pleased with how it's performing. So they might transfer over 100,000-300,000 into a self-directed IRA and then use that to invest, because you're still subject to those annual contributions, which isn't very much. So it can be, in my opinion, it can be a very powerful tool if you're moving over or transferring, rolling over a different retirement account.
And this is also important when I mentioned the different account types. You watch that recording and really study those account types, because I just had this consultation the other day where they were just telling me about the Roth, and then I found out they had an HSA. Well, the important thing about that is we had to figure out where all their retirement accounts were, because they were actually investing into a deal where they needed X amount of money. So understanding that there's more account types that you might be able to contribute to, or maybe you just have and you didn't even realize you can self-direct it, that can be important to get you to whatever goal you're trying to reach on whatever alt asset you're trying to buy. So multiple accounts and partnering is something you want to fully understand.
Excellent. One more question here. I don't know how much we'll be able to get into it, because it's sounds a lot more kind of like advising and very personal to the situation. So from Omar, he has a W-2. He doesn't contribute the max to his 401k because he'd rather put the money into real estate. Okay. If he leaves his job in a couple of years, does it make sense to max it out, leave, then roll it over to a self-directed?
So this is more of a personal question. You really have to answer this for yourself. Now, what I would say, just talking in general, I'm not answering your question specifically because I don't want to give you, advice, I would say. But what I usually tell people is contribute the max up until their match. Contribute to what they match. If you're not satisfied with the investments in your company 401k, don't put above the match. If they're not getting free money from them, then maybe look at taking that extra money and making contributions outside of the plan. Because most people think, oh, I got a 401k, I can't have an IRA. Yeah, you can. You can actually have an IRA, Roth, traditional or Roth, and you can have all of that outside of your company plan and max out the contribution with it, even if you're maxing out the contribution at your 401k. But I always tell people, if you like free money, contribute up to the max. And then whatever you do with the extra, decide, do I want to put it in 401k? Am I happy with it there? Or do I want to have a self-directed IRA and take control of it and invest with my own IRA over here?
Excellent. Awesome. Well, folks, definitely appreciate all of your time and your participation. Nate, thank you for this valuable information. As you can tell, there's a lot around it, but here's the great thing, and this is why we love Directed IRA. You don't need to know it all. You've got an awesome team with Directed IRA that will work with you. And here's the deal, like, We don't get affiliate fees. We don't get finder fees. We don't get paid for sending people to directed IRA. We choose to work with them because of the experience we've had, our investors had. And you don't even need to work with us to use directed IRA. We're not, I mean, they're a preferred partner in this space, but there's nothing connecting us. So if you just want to roll money over to invest in other things, then still connect with them. Right? We just wanted to provide the information, the tools, and the resource, the knowledge to equip you, all of you on this call, to become stronger stewards of your capital. Right?
And can I add something to this? I just want to say, think of us, and even Dallin, think of us as tools in your tool belt, because we don't sell investments. I'm not going to tell you what you should or you shouldn't invest in, but we're a tool in your tool belt if you're looking to get to retirement faster and invest in things that you understand. So reach out to me, whether you're a client or not, walk you through, answer questions, and make you feel comfortable.
Excellent. And folks, want to let you know that we're going to be doing these webinars on a monthly basis. And we're not just going to be talking about self-directed IRAs. We're going to have some high caliber CPAs on these calls talking about some of the tax benefits that are involved with apartment investing, because that's what we do and that's what we're passionate about and what we want to educate people on. So stay tuned. Keep an eye on the emails, because we bring in some incredible people just like Nate onto these webinars. So appreciate you taking time out of your evening. We are going to send out again an email tomorrow. You will get this PowerPoint. You'll get the recording. You'll get that PDF handout. You'll get contact information to connect with either somebody on our team or Nate to help you and just have a strategy session and just see how we can be of service to you. So thank you all for jumping on. Nate, again, thanks so much, man. Appreciate you. And
thanks, everybody.
Appreciate all of you taking your time and joining us this evening. Have a good night.